Good afternoon, everyone. Welcome to our virtual home buying seminar. Wanted to thank all of you for joining us on the call today. A couple reminders before we get started. Any attendee we're going to keep in mute. That will enable all of us to hear what our guests have to say and answer any questions in the chat that may come up. Again, as I mentioned, the chat box is open, so feel free to, that is being monitored throughout the call, so feel free to ask away any questions that you have, and we'll try and get to as many of those as possible during the call. Today's call is recorded, as you just saw, and so we will get started. I'm going to introduce myself. I am Brian McCown. I'm the AVP of Mortgage Operations here at Michigan First Credit Union. We've got a couple of great speakers today, Brock Knoll from our lending team and Jim Cook from our mortgage team. I'm going to let them introduce themselves here in a second. Today's topic is credit and the credit score's effect on rate and on savings. And we will get to answering hopefully a majority of the questions you have or don't even know you have. And then at the end, we'll give you a couple tips and tricks and then close it out. And again, any Q&A, put that in the chat box and we'll answer that as we go, hopefully while we're talking about those topics. So thank you for joining us today. So without further ado, I'm going to turn it over to Brock Knoll, who's our senior underwriting manager on our lending team. So Brock, good afternoon.
Thank you, Brian. Good afternoon, everybody. Thank you for taking time out of your day to be with us today. I know everybody is busy. So glad to have you here. And one thing that I want to bring to the table today and talk about is credit. I've been with the credit union now at Michigan First for over 15 years, working in various roles. But one thing that has stayed true throughout all of my experiences here is helping members with our credit. And I always start off by telling all of our members that it's never too late to get your credit back on track. And your credit score is never too far gone to get it back on track. We've had members down into the upper 300s, if you can believe it, that we've rehabilitated and gotten their score up to a respectable level so they can borrow as their needs are fit. So it's never too far gone. Your score is never too low. And the one thing that separates Michigan First Credit Union, and I with all my heart believe this, from all the other financial institutions, is we are willing to take the time to help you with that. I've seen so many success stories, not only in our regular lending teams, but also with our mortgage team, of sticking with members throughout the process of getting their credit score up where they need it, and then helping them either get that first home, get their dream home, or with whatever financial need that they are looking for at that time. So that's my little spiel for this afternoon. And I really mean it. Just come in and talk to us, whether it's one of our mortgage team or whether it's just one of our regular team members in lending. Come see us. We can give you the tips and tricks that you need to get your credit score back on track.
Thank you, Brock. And no, excellent point. We do these seminars to be informative. What we really want is you to be comfortable with us. And again, reiterate what Brock just said. We are truly here to help you and whatever your particular situation. There is no such thing as a one size fits all at Michigan First. Whatever you need is what we want to be able to give you and help you with. So great. Thank you very much, Brock. I would like to turn this over to Jim Cook to do a little introduction about himself. Jim.
Thanks, Brian. Hello, everyone. This is Jim Cook, mortgage loan officer here at Michigan First Mortgage. I've been in the industry for about 20 years, and everything that Brock said is true. And what's interesting for us as Michigan First Mortgage being part of Michigan First Credit Union is that rather than just being a gatekeeper for home financing, we're able to partner with the credit union to make sure that people have the ability to prepare themselves properly with respect to their credit scores, the content of their credit, and any of their other credit needs, any other accounts, things like that. That gives us a really unique and interesting way to approach the business. It makes it a little bit more relationship driven and less transactional. that's one of the things I like about being at Michigan First Mortgage and working with our membership.
And Jim brings up a good point, as did Brock. One of our big strengths and our, we talk our superpowers is the ability that we have so many resources. We can get you anything you need with mortgage, anything you need with lending. Everything we do financially does start with credit. And so we want to walk you through a bit about the credit report. We'll talk about credit scores a little bit, as Brock and Jim both mentioned. It's never too late to get back on the right track. And we have, an army of team members here at your disposal in whatever type of financial situation you may need. So without further ado, Jim, I'm going to start with you on this one. If I'm someone looking at my credit report, how do I know what information is going to appear on my credit report and what doesn't appear on the credit report?
Good question, Brian. So what I find is in the course of helping our membership and helping home buyers is that somewhat frequently people are surprised how much detail exists within their mortgage credit report. First of all, the mortgage credit report pulls all three bureaus and has all the life of credit information. So not only will it include your current account status, pay history, it'll include things that have been paid off and under what circumstances. Also includes anything derogatory, such as collections and charge-offs, things like that. But also has a little bit of history regarding any name changes, any address, residence that you've been associated with in the past. So there's quite a bit of information there, and I think sometimes people are surprised. And one of the things we try to do is help people understand what's there and understand what their obligation is or their need is in terms of making sense of it, explaining it, and not allowing it to become an impediment to financing a home purchase.
And Jim, you mentioned at the beginning there that we pull all three bureaus on the mortgage side. So if there's three bureaus, that means there's three scores, correct? That come
That's
up?
right. Yeah, we see all the scores.
So which score is used as Michigan First Mortgage? Which score would you use in qualifying somebody of those three?
So it's a question that comes up often, and often members who are applying for mortgages are somewhat surprised. What we do is we look at the three scores and we just put them in order. We take the middle score. So it's not really pegged to one of the specific bureaus. It's the middle score, and that score will really drive what options you have in some ways and what sort of rates are available.
So if you have, example, two borrowers on a loan application, so now you'll have 6 scores. Which score becomes the credit score of the loan?
So in that case, with multiple borrowers, we're always going to take the middle score for each borrower as their score. And then for the file itself, for the application in total, we take the lower of those 2 scores, or however many scores there are, depending on the number of borrowers. But in your example, there's 2 borrowers. They each have a middle score. We're going to look at the lower of the 2 scores between those 2 applicants.
Right, and that's very important and I'm glad you talked about that. That's very important for people to know, especially when they have someone else on the loan with them to just understand where they're at positionally with credit. Brock, I'm going to come over to you. When we get into the loan process itself, we start the mortgage process. We have an application. Once that credit report is pulled, why is it important to watch the credit activity throughout the process?
It's really important to, especially when you get to the point where you've actually applied for a mortgage, and if you've gotten that approval for the mortgage, you really want to watch what you're doing with your credit activity, because any little thing that you can do can affect that score, right? So if you didn't lock in your rate for whatever reason, or if the mortgage process gets drawn out, and as you and Jim know, there can be several reasons for that, whether you're purchasing a home, there are other things that happen that are out of your control with that process. or you're refinancing, sometimes it does get drawn out and we have to pull a new credit report. It's really, really important to watch your lending needs during that time. I'll give you a great example. If you go out and you try to buy a car after you've already been approved for your mortgage, you're going to go to the car dealership more than likely, and you're going to see if you can get approved for your car. What that car dealership is going to do is they're going to see what rates are out there for you. So they're going to shop your information out to different banks, different credit unions to see who's going to give them the best deal. What that ends up being for us in the real world, if we're buying a car, is a bunch of credit pulls on our credit report, right? So those credit pulls can drop your score. If you end up getting a new car, it's going to show up as a new loan on your credit report. That can drop your score. So it's not only how well you pay your bills during that time, which is paramount, probably the most important thing, but a lot of people don't realize that's not the only thing that goes into your credit score, right? So if you're going out and shopping for new credit, if you're using your credit cards during that time, all of those things affect your score. So it's best to sit tight and try to limit that activity as much as possible.
And this kind of goes to a question you started to answer, and I know you get asked a lot, Jim. I know you get asked a lot, but Brock, the question comes up: should I take out new credit during the mortgage process?
It should be the last resort. If you can get through the mortgage process without taking on new credit, that's going to be most beneficial to you just because of the credit score implications. You want that credit score to stay as high as possible during the mortgage process. You don't want to fall into a situation where it drops a lot and you may lose your mortgage approval because of where your score went, where your debt to income ratio may have went because you took on new debt. So look, we all know, especially right now in this market, it's not cheap to go buy a car. So if you add a $500 or $600, $700 car payment on top of your debt, that could be the difference between you being approved for that mortgage and you not being approved for that mortgage anymore. So to answer your question really bluntly, you should try to limit any new credit if possible. If you really, really have to, my suggestion would be, if you're working with somebody like Jim, to call him and talk to him first and say, Jim, I need a new car right now. And he could look at the ratios for you. He could look at how the mortgage is going through the process of that time and see how much that's going to impact you. Communication is key. So if you really have to, I would suggest you call your loan officer and talk to him about it first.
And I'm sure Jim will agree with that. I know that's great advice. We've all had the situations, Jim, Brock, myself, just we've seen in mortgage where, credit, once it's pulled, is not a static thing. It will continue to be monitored. As you said, it impacts credit scores, but it also impacts debt. And from the mortgage standpoint, any debt that comes up, a new car, you open, you just can't stay away from that 30% discount at Kohl's. And, there's some shopping that's done there that adds to your debt load. And it may be the difference between you getting that house of your dreams and suddenly not being able to qualify if you've acquired too much debt. Probably the other one is, I'm getting a new house. I already went out and bought the furniture, and now that debt hits your credit report. As much as we're excited to hit IKEA and go shop for the loans, it's best to hold off. Or, as you said, Rob, make sure, talk to us first, talk to, your loan officer, talk to someone at Michigan First and walk through that solution. We're there to help you all the way through, not just take the app and close the loan, but anything that could impact your credit, before the process or through the process as well. So, Jim, got another question here. Why are the scores provided by the monitoring services for credit different than the scores used by the mortgage lenders?
The monitoring services, I think they offer a great assistance, and I highly recommend that you use a monitoring service to keep track of your scores and to get any sort of suggestions from the service that could improve your scoring, things like that. And they have great value. What's different though is, and if you read the fine print on most of the agreements here, you'll see that the monitoring services are really pointing to the last 24 months of your activity. And so because a mortgage a credit report is so thorough and is life of credit essentially, there can be things that are missed. And so very often the model that they use, they try to get scores that are as close as possible to the actual bureau scores. But because they're using a short-term window, there's always going to be some variation. Now, what I would add is, as I said, I still recommend using them. And their greatest advantage, or their greatest assistance they provide, in my opinion, for someone seeking a mortgage, is that they'll alert you to the direction of your scores. So while they may not give you exactly what your score is that we're going to see, what's great is they're fairly accurate with giving you sort of the direction, the trajectory of your score. If it says, hey, you did something, changed something, you paid down this revolving account and it improved your score by 10 points, that's probably accurate. And so I think for that reason, I still recommend them, but that kind of explains the difference in their scoring and the scoring you see with a mortgage lender.
No, excellent. And I know we all get that question a lot, so that's great information. For that, there is a question in the chat. When applying for a mortgage, how long is the pre-approval? I'm assuming how long does the pre-approval last or go for?
And I'll answer that. And Brian, you're in the back office side, so you tell me if I go off track. But here's what I advise my members, is that it's all based on how long specific documents last. So we'll start off with a pre-approval. One of the first things we do is pull this credit report. That credit report is valid for 120 days. And so if for whatever reason, if you're, and in this market, it's not uncommon for you to search for a home for a longer period than that, in which case we would have to pull a new credit report. There's also different periods that, say, income documents are valid or asset documents are valid. And because of that, what we usually do is we'll write a pre-approval letter that says this letter is good for 30 days. Now, it doesn't mean that your actual pre-approval status is only good for 30 days, but what it means is that you, a member seeking a mortgage, and me, a loan officer, we're going to have a conversation at least every 30 days to say what changed, what happened in the rate market, what happened in the housing market, et cetera, what could impact this, and we'll renew and rewrite a new approval letter. I hope that helps.
No, great answer. I want to get back into the content of the credit report itself. These questions come up a lot. What effect does medical collections have on the mortgage application process? So Jim, we'll start with you on that one.
Okay. So yeah, medical collections seem to be fairly common. So what I generally advise is that in many cases, you may not even have been aware that that you were responsible for this fee. It shows up on your credit report as a collection. It's going to have some impact on your score, and so there's two sides to the answer here. Does it impact your score? Yes, it does. The presence of a collection will have an impact. Are you required to pay it off in order to obtain and close your mortgage to finance your home purchase? In most cases, no. Medical collections are treated a little bit differently than other types of collections because of the circumstances. It's not like you walked into an emergency room at some point, seeking this new account. You just ended up in that situation. So they're not going to be necessarily required to be paid off, but the reality is they have some impact on your score. And so the conversation about what to do about them is going to be based on, do we need to improve your score? So how do we do that? And do you anticipate paying this off, or is this something that you're still working with your health insurance provider to pay? So there's a few things, but they're viewed a little bit differently.
Great, thank you. And Brock, Jim just gave an example of how medical collections may not have to pay them off, but they can certainly impact your credit score. What are some of the types of things that can affect the credit score? We touched a little bit about during the mortgage process, but things that a borrower may or may not do that can affect their score throughout the process.
Sure. I did want to piggyback on what Jim was just talking about with the medical collections, if I can, for a second, because there was some new legislation that happened within the last year regarding medical collections. So as of July 1st of 2022, so over a year ago now, the time before medical collections can appear on your credit report increased from 6 months to a year. So it gives you a little bit more time to get your medical debt paid off before it's going to hit your credit report. All right. And then starting of March of this year, so just 5-6 months ago, medical collections that are under $500 are no longer going to show up on your credit report. So there is some good news for us as consumers, because as you've seen, Brian, as you've seen, Jim, over the years, geez, a $75 medical collection will show up on a credit report and really tank a score. And it just seems so trivial and small. And sometimes when we're talking to our members, they say, well, my insurance should have covered that. We've run into that a lot over the years. These were put into place to try to help with that. So there is a little bit of a light at the end of the tunnel with the medical collection. So that certainly helps. To answer your question, one thing I wanted to key in on here, because it's one of those hidden things that a lot of members don't think about that can affect their credit score, is something that's called credit capacity. Credit capacity almost affects your score as much as how well you pay your credit. A lot of members just think that's the only thing that affects your credit score, is paying things on time. What is credit capacity? Well, every single loan that you have on your credit report that is a revolving line, and revolving lines are those things like credit cards where you can use them, you pay them down, and you can reuse them again. So they're just cyclical. You can keep on using them. Those affect your credit capacity. So if you added up all of your credit limits on your credit cards and lines of credit, you have a number. Okay. How much of that number you're using, that's your credit capacity. So if you have $10,000 available on your credit cards that you can go use, if you're using all 10,000 of that, if you're maxed out completely on your credit cards, your capacity is going to be zero. On the other hand, if you're not using any of those credit cards, you're going to be at 100% capacity, which means you can go out and use it all. You want to be closer to zero. The more you max out your credit cards, the lower your credit score is going to go. All right. So in this world, if you get a mortgage approval and then you decide you want, okay, I have my approval now, I'm just going to go out and buy stuff with my credit cards. Well, you're going to affect your score, and it could be potentially dangerous for you because it could affect your approval in the long run. That's one of those things that members don't really think about after the mortgage approval. They think, okay, we've heard about, I'm not going to go open up new credit, and I'm not going to have my credit pulled, but you are getting new credit if you go out and charge up your credit card. So try to keep your credit card balances as low as possible before and during the mortgage process, so your score can be as high as possible.
No, excellent point with the credit capacity, and I think that's something that not a lot of folks realize with the balances. I know there's a question. There was a question on student loans, and it looks like Serene is looking at that in the chat. So we've got a couple minutes left, and I wanted to make sure we want to talk about two things really quick. So, Jim, the questions about credit freeze or fraud alert that have been placed on the report, or consumers or members placed them on the report for a variety of reasons. Is that a concern, credit freezes or fraud alerts on credit reports?
So yes, so this is an issue where you're coming to us to make application for a mortgage or a mortgage pre-approval. And we're pulling that mortgage credit report with all three bureaus. You may have filed a fraud alert or a credit freeze with any of the three bureaus, in which case it would prevent us from getting the full, credit report information because you've frozen it, or if you've put an alert on it, it would prevent us from being able to move forward with actually closing a loan for you. So the two pieces of information that I would share would be regarding the freeze. Make sure that you remove any freezes so that when you come to us, we pull a report, we get all three bureaus, scores, and full information. With respect to the fraud alert, this is typically something that you may have placed on your account because you were alerted that there was someone that you had a relationship at an institution you had a relationship with may have been hacked into, something like that. So you may have been advised, hey, put a fraud alert, and that stays on for 7 years. That's fine. We can move forward. We can close a loan with a fraud alert in place. But what we see sometimes is during the time that the fraud alert is in place, you may have changed your primary phone number or something like that. So the phone number you provide on that fraud alert, we're required to contact you using that information to validate your identity. If that information is not current, then we're sort of stuck. We would be unable to move forward. So those are the two things to think about before you start the process. I hope that helps, Brian, if you have any more information.
No, that's perfect. Really, it's do your due diligence. There's always reasons why there's credit freezes on there or fraud alerts on there, and just understanding what they are and what to do throughout the process, as you just explained, is vital. So amazingly, we are almost out of time at the bottom of the hour. So why don't we wrap up? I'm going to start with you, Brock. We talked at the beginning to all those on the call. We're going to give a little tips and tricks or little reminders and takeaways. So Brock, why don't you start us off?
Sure. Just to piggyback off the credit capacity situation that we talked about, what it is and how it can help your score. Let's look at it in the reverse. Not only can it make your score go down, but you can also improve your credit score by improving your credit capacity. So if you have maxed out credit cards, if you have balances on your credit cards, if you want to clean up your credit before you apply for a mortgage, that's the fastest way to do it. Pay down your cards. And I know not all of us have money in the bank that we can go pay down our cards, but there are other ways you can do it. For example, if you do have $10,000 in credit cards and they're all maxed out, you can do what's called a debt consolidation loan. Okay. So if you took that $10,000 in credit cards and you paid it off with doing a personal loan or an unsecured loan, those types of loans where you have a certain term and you pay it off and you're done with it, those don't affect your credit capacity. So all you're doing is shifting your debt from credit cards over to a personal loan. You could increase your score significantly by doing that. For just about every percentage point you gain in credit capacity, you can gain about a point on your credit score. So if you're down at 600, right, and you pay off all of your credit card debt, whether you can do it by yourself or with a debt consolidation loan, you could potentially increase your score by almost 100 points. And as you and Jim know, in our world, 100 points, that's huge. That could be certainly the difference between you getting approved or not, but it can also affect what type of rate you're going to get on the loans that you apply for. So credit capacity is huge. It's the quickest way to increase your score. It's also one of the quickest ways to decrease your score. So you just want to make sure you're doing that to the most beneficial situation for you. If you have questions about it, or if you want us to look at your particular situation, just to you individually, which is what we love to do, come in and talk to one of us. We are more than happy to look at your situation, more than happy to take a look at your credit report and give you some tips along the way to get you where you need to go. Brian and Jim, over on my side in our lending department, we hear so many success stories of your mortgage team talking to a member, and then it could be 2 or 3 years later, you've worked with them for that long and they finally get that dream house. It doesn't always take that long, but I love working at Michigan First because we will take that time if you need it. We are here to educate you. We are here to help you and individualize, our loans to you so we can help you in your situation. Come in and talk to us. If all else fails, come in and talk to us. We are more than happy to point you in the right direction and get you where you need to go.
Great, thank you, Ryan. Yeah, that last point, I'm going to turn it over to Jim to get your 3 points, and then we'll have contact information up for those on the phone in our next slide. So, Jim, why don't you give us the 3 tips from the mortgage side?
So I have these 3 takeaways, and I probably talk to almost everybody about them all the time, not just on a presentation call. And some of them you'll recognize we've already covered, but they're important. So I just want to tick through them again. Use a credit monitoring service in preparation for applying for a mortgage. So, in the year or 6 months or whatever lead time you have before you're making application, use that service to guide yourself, to get tips, and then couple that with any advice you can get from the credit union branch personnel as well. They're great help. Second, keep in mind that when you do make improvements to your credit for the purpose of preparing for making application for a mortgage, remember that these don't show up in real time. And I think sometimes in our fast moving data driven world, people kind of are stumped by that. Like, well, I paid that off yesterday. Why don't you guys see that? And that's just not the way the credit report model works. You need to pay it off. Then you have to wait for that creditor to report it to the credit bureaus. Then the credit bureaus make it part of their scoring model and information reported on your credit report. And so based on that, it could be 30 days or 60 days at times before that truly shows up in your scores. And then the third one is really once you make application, and again, I think Brock and I have said this at least a couple of times already. Once you make application for a mortgage loan, discuss any changes that you're going to make to your credit with your loan officer, and make a good decision that doesn't prevent you from getting the mortgage that you've applied for. So those are the three things that I tell everybody.
Thank you both very much for those last tips. We talked about the contact information. You have that here. Jim's on the mortgage side, Jim's direct contact information. If you have any questions about the mortgage process, reach out to him or any of our loan officers. You can go on our website, michiganfirst.com/mortgage. If you have general information, we have an 800 number if you want to talk about other options, as Brock said, about credit. The big takeaway is have the conversations with us. Look at this proactively and making sure that if you are prepared to take action on your credit, if you want to get a home, you want to get a mortgage, and you're unsure, we have a variety of options to help you out from the lending side, debt consolidation, from the mortgage side on how to purchase a home. So we're very happy to help you. We are ready. We're willing to go. We are always here. We have a 24-hour call center. So I want to thank Jim and Brock for sharing their wisdom with. Thank all of you for joining us. And I think we have one more slide. As we talk about, the home buying process, also keep in mind Michigan First, besides the lending and the mortgage project, we have an insurance agency. And again, with the same vein, we are ready and willing to help you for any of your insurance needs, which are always there when you get a mortgage. But auto, life, any insurance needs you have, we'd be happy to assist you as well. And with that, I thank everyone for joining us. Hopefully you've learned a lot, and everyone have a great rest of your day. And thank you for joining Michigan First.